So I'm really pleased to have our speakers on our panel who are actually doing the hard work of water risk integration and really putting their money where their mouth is on these issues and forging ahead. And I was delighted to speak with all three participants for the survey and really found their practices insightful and very different and unique. So I look forward to introducing them to you. We did lose Daniel Wild of Robeco Sam. Unfortunately, his flight didn't get off the ground, and he's flying over to New York as we speak from Europe, so he wasn't able to join us, so he does give his apologies. So I did want to introduce, we have Robert Fernandez at the far end from Breckinridge Capital Advisors, and they are a fixed income fund manager based out of Boston. I guess who's digging out of snow, under the snow probably. And so he's been, he has 15 years of experience, mostly as a research analyst, senior research analyst at Opus Investment Management, State Street Bank, as well as Breckinridge, and is now vice president of research there as well. And he also holds positions with the Boston Security Analyst Society, CFA Institute, the National Federation of Municipal Analysts. So we're happy to welcome you, Robert. And okay, great. So do you guys have your mics on?
Yeah, I have mine on.
Okay,
yeah.
Great. And so I would just do a quick introduction. I'm going to dive into some questions. So we also have Beth Williamson here as well, a research analyst from Trillium Asset Management, previously of Portfolio 21, which merged with Trillium recently. And she's really helped build Portfolio 21's ESG integration methods and really taking a deep sector approach. And prior to that, Beth also had experience with working with Oxfam America and has focused on worker rights and the agricultural sector as well. And we're really pleased to have Beth fly over from Portland. I also wanted to mention that they really have a global approach as well. So Bruce, I had to print out your definitely had to print out your bio. It's very impressive. So Bruce is portfolio manager at Sustainable Insight Capital Management. And he's also has been with Deutsche Bank Asset Management, where he focused on clean tech, water, agriculture-based investment strategies. And he has serves as a trustee and a board member for many different organizations, including the Robert and Patricia Schweitzer Foundation, the Christopher Reynolds Foundation, and also is on the Environmental Studies board at the University of Wisconsin in Madison, and also works with SASB, the Sustainable Accounting Standards Board, on their advisory council, and has a background both in science and investment management. So great to have you on board as well. So I wanted to kick things off and start off with Robert, if I may. I wanted to have the panelists just briefly just get into the nitty-gritties and the details of what their current practices are on ESG and water integration, and if you can really provide potentially details on that process, and start with Rob, and we'll move across.
Sure, I'd be happy to. And you mentioning me being from Boston and the snow, and thinking about water risks in general, the snow that we had, about 100 inches over 2 months, January and February, brought to mind and brought to light a number of other water risks that we could probably talk about at another conference, but including, colorful terms like ice dams, frost heaves, and then probably the most troublesome is trying to figure out what to do with your kids during yet another blizzard. It was brought to mind a number of risks. Maybe we can address those at a future conference. But so Breckinridge Capital Advisors, just for a little bit of background, we're a high-grade fixed income manager. We're focused specifically on high-grade fixed income. We offer sustainable, tax-exempt as well as taxable bond strategies. And probably about 4 years ago, we formalized our sustainable investment strategies, where we've integrated ESG, the analysis of ESG, into both corporate research, our corporate credit research process, as well as our municipal research process. And so I can speak briefly to both of those, but maybe starting with the municipal side, we we formulated and put together frameworks to assess ESG risks in a number of different municipal sectors. And so specifically related to water and water risks, we thought a lot about how we can consider environmental social governance risks in water systems in the United States. And municipal bonds make up a decent percentage of our assets, and we wanted to just get a better feel for these various risks in these securities. So we worked closely with Ceres to formulate a methodology to consider these various risks. We weighted what we defined would be material kind of indicators within the water and sewer system. And these indicators are weighted and then scored, and then with that, it comes together in a sustainability rating. So that's just a kind of a snapshot for the municipal sector. For corporates, we have a similar kind of methodology, but instead of obtaining all this kind of data that we had to compile and on our own for munis, we've relied to some degree on ESG research from MSCI, Sustainalytics, Bloomberg, as well as our own analysis of corporate sustainability reports and information. And it's kind of a similar process where the information we compile, score, and then rate, and then the ratings will impact, the sustainability ratings will impact our overall credit assessment of both the company and the municipality. So I guess I could stop there.
Thank you. So please go ahead.
Sure, thanks. Good morning, everybody. Nice to see a lot of familiar faces. And so a lot of you know more about this than I think I do, given the history of a lot of the folks in the room. So what I'm going to do is just tell you a little bit about what we do today, and then hopefully you can ask some really tough questions, because I know a lot of you will. But before you go on and speak, I know all of you have done this before, like the minute before you go on, something has to flash in your head about, why am I doing this? What do I have to offer this group of esteemed people? And the image that came back to me was really Professor Poff's image of building dams, because how I first got into water, that's really transcended everything else I've done throughout my career, was building dams, but very small-scale dams. I was a Peace Corps volunteer building little rivulets of water to build subsistence fish farms. And there's a real satisfaction with being able to do that, where you have the perception of controlling water. Like you've taken this rivulet and you've moved it so you could get the water into a place where it could provide a human benefit, growing some protein for subsistence farmers. That really is an important component when we scale up and think about everything else we're going to talk about today, about water and where is it and how do you move it and quantity and quality, et cetera. So, I know that we all want to talk about water as a risk factor, whether it's priced in capital markets or not, and that's all important, but we also have to think that, the real importance of water is to freshwater ecosystems, but also to human subsistence and human survival. And I think that's a very important thing that we all need to consider, especially like right out in California right now. I mean, it's incredible what's going on there in terms of the drought and reactions, both politically, economically, and socially. And we always have to consider the human factor when thinking about this. So with that preamble, then, I will launch into more of a quanty, geeky investment process around our capital markets pricing water. And when I talk about capital markets, I'm talking about public equity capital markets. I'm not talking about water arbitrage and land deals or trying to develop new policies for water pricing in the Colorado Basin. Really, our capital markets, the public equity, and I think it's harder in public equity than in bonds, because the equity risk premium is kind of like this weird thing out there, where bonds you have a coupon, you have an obligation. There's really no obligation in the equity risk premium. So my question about how do we then integrate pricing mechanism in the capital markets to public equity securities in two ways. One, first, within the water theme, like water companies that are either utilities, industrials, or technologies, and then the broader kind of universe of companies that have water risks embedded in them. And the first thing that we do is we say, in our investment process, we have to have a strong conviction on a company in general, on its financial health. Now, the water risk is embedded in those financials, and it's a matter of teasing that out and figuring out, well, where is there a pressure point? Then we find those pressure points, estimate what that pressure point is going to cost, because in general it's a cost. We could talk about opportunities later, but for now it's cost. And then can we then come up with an adjusted commitment or expected return of that company based on our adjusted costs of its water risk? And then we have these adjusted expected returns on companies. So let me just repeat that. We generate an expected return on a company. We then adjust those expected returns based on what we estimate as a risk to that expected return based on water. And then we have an adjusted expected return. So two things before I move on to the final step in portfolio construction, which is water, of course, is not the only factor that matters. I know we all want to think it is the only thing that matters, but it's not the only thing that matters. So when we go then to do portfolio construction, we believe in our firm, Sustainable Insight Capital, is really committed to managing the risk in our portfolio construction against common benchmarks, because most institutions, and in fact most individuals, any retail investor will always say, well, how do you do against the S&P? So people want to know. We're measuring risk against the benchmarks. We have to then use that water risk factor as one of many factors that go into portfolio construction. So when we run our portfolio construction process to determine the optimal portfolio against the benchmark, we may in fact invest in companies that have high water risk, but because they have other attributes, like they might be more liquid or have more momentum, or they're not either a growth or a value company. And those factors, whether we like the CAPM model or not, really do drive private equity market pricing in today's environment. So we have to then use those factors to adjust our portfolio. So when we come up with our portfolio, then we don't have just a basket of good ESG companies or good water risk-adjusted companies. We have a portfolio as entity in itself that has a risk-return profile against the benchmark. Now, I know that's, like I said, it's kind of quanty and geeky, but it's very important to understand portfolio construction when talking about pricing in capital markets. So the conclusion, therefore, is when we have our integration of the ESG or the water risk factor into our portfolio construction, it absolutely is part of the estimation of our expected returns on companies. However, it may not always result in a pure portfolio of great water companies due to other factors. So that's the first thing in the broad market. The other thing I just wanted to point out, and I'll stop there, which is the thematic. So then there's the thematic. So you want to buy a fund focused entirely and exclusively on water companies, water industrials, utilities, technologies. And we have found through a lot of our research that this space is it's actually a great space to invest in, but it's very hard to invest in it and really beat a benchmark, right? And so you have to think, is an institutional investor going to, or even an individual, going to do an asset allocation process that will result in an allocation to a water-themed fund? Now, if you can get through that process and get to that point, then using the appropriate benchmark is going to be critical. Because if you just say, we should buy water and we'll benchmark it against the MSCI World, that is not the appropriate benchmark. And it seems that, and we've done a lot of research on this, that most of the funds out there in the world running water-themed funds are benchmarking against the MSCI World, not any of the water indexes. And then therefore, it's very hard to determine whether an active manager can prove any value for the fees that you're going to pay for that kind of allocation. But I see somebody laughing in the background, because how you get through that asset allocation process to ultimately arrive to we need a thematic fund in water, that's also another question we could take up later. So I'll stop there.
Thank you. And Beth, if you can give some details. I know, speaking with Beth, I was really impressed at the depth of her approach looking at different sectors. So if you could get into some of those details.
Absolutely. So, is that too loud? No, okay. Our approach at Trillium, well, I first should explain. Portfolio 21 was a global mutual fund that was started in 1999. We merged with Trillium in December of 2014, and now Trillium offers a global equity strategy, and in fund form, it's Portfolio 21. So my work continues on the global equity. In 1999, when Portfolio 21 was launched, we constructed 21 environmental criteria that we continue to use today, that we assessed all companies with. And at the time we were developing the fund, we intended it to be a domestic fund, but at the time we could not find enough diverse companies in the US that met our high environmental criteria. So by default, it became a global fund because Europe was just a little more ahead of the curve. So just a little background on our fund. Since then, we've added over 27 social and governance criteria that are also used across all companies, across all sectors. About 5 years ago, though, it was beginning to be more difficult to see who was leading and who was lagging, because environmental reporting and sustainability reporting was really gaining traction. And so at that time, I started thinking, okay, how can we weight ESG indicators that are most relevant to particular, not just sectors, but industries and sub-industries, because I think it's really important that you look at companies within the sub-industry or industry perspective, because they're going to have different issues. Not that I don't care, but financial institutions, their greenhouse gases are just not the core indicator. But if you look at airlines, yes, I want to look at greenhouse gases. So we decided to use the GICS classification system, and we are still in the process of going industry or by sub-industry and creating an ESG thesis for each. And this thesis is more qualitative. I'm using third-party research, industry reports, sell-side research to create what we believe to be the core environmental indicators. And through this process, we've identified 14 industries that water is a key indicator that we feel companies within those 14 need to be addressing water at a very high level for them to even make it into what we call our galaxy. And then we do additional work, and maybe it gets into our buy universe. So that's the structure we've created. And then once the ESG analyst, which is myself, I fall into that category, through the investment management team, we work with the portfolio managers to make sure that we're addressing, the financial considerations. But in our funds, if a company is not addressing ESG risk indicators, they don't even get to the portfolio managers. So a little different response, and I could go into some of the industry examples now, or we can wait.
Let's
I think,
pause for a
yeah.
second. Thank you, Beth, and thank you all. I think I really like that you had all very different, unique approaches, and I mean, there's other folks in this room that have yet other approaches. So as our report indicates too, I mean, there's no one size fits all, obviously, and there's just so many different ways you can really begin to look at water. I want to make sure we're going to have enough time for questions. Can you make sure around 20 minutes to let everybody jump in? But I just wanted to really get a little bit more into the details. And Robert, I wanted to start with you in terms of, can you provide an example where, let's say either by a specific buy-sell decision or sector, where you really kind of created that alpha for your clients by looking at water? And if you can maybe just give a bit of a case study, what were the indicators you were looking at, what were the sector, the stock, and how you benefited from that, or how it really paid off?
Yeah, we specifically to alpha, I guess I just wanted to mention our focus from an ESG integration point is related to risk mitigation. So we would like to outperform, but in the fixed income space, our primary focus, in part due to our investment mission of capital preservation, we're looking to protect the downside most specifically. But certainly over the longer term, we would hope that through our ESG integration, that our performance would at least match or would hopefully have some alpha versus the benchmark, which generally is the Gov Credit Index for the taxable bond portfolios that we manage. But a specific example related to ESG probably would be, and related to water, would be Coca-Cola. It's a company that's managing its water risks quite well. It has a very extensive water stewardship plan. Now, at times, we're hoping over the longer term an investment in Coca-Cola for our taxable, sustainable clients would generate that alpha, because by managing these risks, hopefully it would protect its business, the sustainability of its business over the longer term. As far as specific to outperformance, the one issue in fixed income right now is that spreads are exceedingly tight. The overall valuation is exceedingly tight. So potentially we may have picked up a couple extra basis points versus a comparable beverage or comparably rated security. But the reason why I bring up Coca-Cola is because it's managing its water risks well and its ESG risks well, that we feel that a company like that over the longer term would be a sound investment for our clients. So sometimes it's hard to measure alpha in fixed income, especially in high grade fixed income space where we are focused on. But like I mentioned, it's primarily about risk mitigation and protecting the downside. And so we hope to identify companies and management teams that are being progressive about managing water risks as well as ESG risks in general. And by identifying those companies, we feel that over the long term they'll be sounder investments.
Can you also, I really appreciated some of your approaches to the municipal bond market as well, and some of the indicators you were capturing. Do you mind giving an example from the muni side as well?
Yeah, absolutely. So for the water, we call it water and sewer framework. Essentially, it's a methodology of where we've put together about 16 indicators, mostly data points. So we're drawing information. So an environmental indicator that we're looking at is drought-related risk. So we're looking at the Palmer Drought Severity Index, and also another drought measure to get an understanding of a particular community's drought risk, or if it's prone to water stress. If that area is prone to water stress, we will dock or penalize the score for that water and sewer utility. So we certainly understand that we're penalizing utility for that drought risk, but we're not at that point assessing whether they're doing a nice job managing through what could be a difficult situation for them. That's farther down in our process, where we take a look at whether the community has a comprehensive sustainability plan that considers water conservation efforts, if they have a in-depth drought contingency plan as well. So the framework in its entirety is both qualitative and quantitative, and we're looking at other sources of data such as rate affordability, and there's also the qualitative assessment as well. So all of that together is scored. It's a score that ranges from 100 to 0, 100 being the best, and that equates to a sustainability rating. And what I didn't mention before is that sustainability rating. So the credit analysts. We have 13 credit analysts. They do credit research as well as ESG research. They're all involved in the process. So let's say we're looking at El Paso water and sewer. And we identify that that particular utility has high kind of elevated ESG risks. If that's the case, we have a sustainability rating scale. The scale is S1 to S4. If that's utility, if we deem has high risks, that would be farther down on the scale, so it would be an S3 or S4. The analyst would then be able to, or is guided to, downgrade their overall credit assessment of that utility to take into account these elevated ESG risks. And then the last step when it comes to valuation, so let's say El Paso Water and Sewer, and this is just an example, I don't mean to criticize El Paso Water and Sewer, but because they are doing a lot of very sound long-term water management planning. Let's say the traditional rating, our internal rating would have been an A+, the analyst downgrades it to an A for its elevated ESG risks. In partnership with the trader would not buy that particular utility unless the spread, the valuation, would come at an A level. So that's where we feel that we want to incorporate, by doing this, we're incorporating that evaluation of ESG into the overall valuation process.
I know I want to leave time for questions. I was just going to maybe skip ahead and ask our other two panelists if you can talk maybe about some other sectors where you really found water to be critical and really sort of drove a different buy-sell decision or a different approach if you had not been looking at water. And I'll probably open it up to questions as well. I know we wanted to touch also on sort of what the panel's aspirations were for the future on deepening water and ESG integration. So I don't know if you can throw that in there somehow or into your questions. But yeah, if you can answer those two questions, Bruce, and then we'll open it up.
Sure. So, well, we've taken a really deep dive, in no pun intended, on into agriculture. Obviously, 70% of water is used in agriculture, and that's a huge driver. And I know I'm going to get some tomatoes thrown at me at this, but in many ways, this argument about water not being priced, I think there's a great proxy for water pricing. It's in the imputed costs of grains that are traded globally. I see some folks who know this implicitly, that actually the hundreds of millions of metric tons of grains traded every day across the globe is a proxy for water. Now, is it priced efficiently? Hard to say. It's efficient for today. Is it efficient for the work on the Ogallala Aquifer? Probably not, right? But that's a 10, 20-year issue, right? Or hopefully a 10 or 20-year issue. I hope it's not any sooner than that. But the point being is that water pricing today in capital markets, whether it be through equities or commodities, is really priced only through proxies, right? So either grains or the equity companies, the equity behind the companies that we're looking at. And so in agriculture, we took this idea and we said, okay, well, how are the large agribusinesses across the globe dealing with water? And so we're not talking about farmers. We're talking about, although some ag companies are vertically integrated and have production assets, but most agribusinesses, whether it be inputs, so fertilizer, seeds, machinery, all the mining that goes into agriculture, then processing, handling, and logistics, where arguably more than 70% of the revenue of in the food and ag value chain resides. Unfortunately, it does not reside with the farmer, right? So that's where all the water use is. There's a lot of water sustainability opportunities among those companies. So we looked at these factors and really ran a process similar to what I described earlier to say, well, if we were to run a portfolio that optimized for those companies who we deemed as having a better water conservation practice in their operations, what would that look like in terms of a portfolio and in terms of portfolio construction? And so within the agribusiness world, which we were constrained to an agribusiness universe, so this was not a portfolio benchmarked against the MSCI world where you had other companies way downstream in consumer goods, but we were looking at the agriculture index because we were trying to demonstrate our ability to understand the water risks among agribusinesses. And we found that, in fact, we would have a better risk-adjusted return, but it was more risk, right? The portfolio had a greater amount of what we call tracking error, more risk in the portfolio with higher rated water companies than lower performing water companies. But it also had other features, which I think is really important to consider, which is it lowered our exposure to overall market risk, right? And so if you're going to have an actively managed fund investing using water as a proxy for good management or just as a theme within agriculture, which is obviously a very important sector or a very important combination of sectors, that you're going to have a lower exposure to overall market risk, and so that was not something we wanted to pursue. If you have 80, what we call, an 80 basis point exposure to beta, that was too low. And also we ended up tilting towards larger companies and value companies versus core companies. And we also found that, and this is a pun intended, which is that liquidity of these companies actually drew away from our return. So we found that very interesting. And what this exercise taught us is that when making any explicit tilts towards any factor, whether it be water or any other ESG factor, one has to take into consideration the benchmark that you're using and the unintended risks that you'll be taking. So we optimize then for water, all of a sudden we've got low beta. Well, how do we manage that? Right? Because we don't want to have low beta. We want to have at least beta of 1, if not more. Right? So those unintended risks of optimizing or doing any kind of tilt towards water or any other ESG factor really has dramatic implications for the rest of your portfolio. And for institutional investors out there, this is paramount to how they can use your product in their asset allocation. They have to know what your factor exposures are, what your volatility is, how sensitive you are to these other factors. And so that example of using agribusiness as a way of understanding water led us to continue to use this on an ongoing basis. And right now it's not really that much price, but we can track it, and as more policy, more corporate actions, more shareholder engagements come online as organizations like Ceres continue to promote, then that pricing will eventually come into line, I think, with where all of our expectations are. But today, it's still pretty muted and not really all that material in terms of really giving you that equity risk premium.
So Beth, if you can
Sure.
dive in.
So I'd like to just speak to the variety of water metrics that can be identified and should be analyzed depending on what industry you're looking at. So first, I'll just speak to the hotel, resort, and cruise line sub-industry. We were looking at this sub-industry with a $10 billion market cap, and there were many companies, but there were 3 well-known hotel brands. One company did not use any sort of water risk assessment to analyze their properties. So while they said their properties in the Caribbean had water risk due to climate change, they weren't really looking at the big picture. Another hotel company used the World Resource Institute's aqueduct tool, and it showed that 48% of their properties were in extremely high or high risk water zones, and that their growth strategy was also in these extremely high or high risk. So to me, that was a big red flag, and their mitigation programs were in their infancies. A third company, which has been approved for our universe, using the same tool, showed 23% of their property portfolios were in the extremely high and low, and we're using that information to strategize the growth of new property development. So it was very much embedded in upper management and their future growth. So that's just one indicator that we use for the hotels. If you're looking at semiconductors, a semiconductor, a fab plant uses 2 to 4 million gallons of water per day. That is about the consumption of a city of 40 to 50,000 people. So their water use is enormous, and it needs to be ultra pure, which is energy intensive process to get it to that point. So when looking at semiconductors companies, we want to look at the recycling rate, how much water is being reused and purified to that ultra pure state, and also are they working to reduce water per wafer, and who is doing that the best, really. So Taiwan Semiconductor is a company that we feel is really leading as far as water efficiency. So then if you look at apparel, luxury goods, Nike is always a leader in their environmental initiatives. And what stood out to me is that they're looking at their supply chain. First of all, they're very transparent in their supply chain. They list the locations of every supplier they use. And that they're looking not just at the country risk, but also at the particular local water basin of that supplier, and are then implementing the right water measures to minimize that particular supplier's impact. And those figures are going into the country risk index, and that also helps determine which suppliers they continue to use.
Beth, I might just pause.
Please.
We probably don't have time to go into more sectors, but I think there's a fantastic example that you really do have to take a sector-based approach, and that it does take the homework to really understand the water life cycle of those particular sectors and the needs, and then placing it on a location, or really using sort of the context of where those companies are operating. So those are fantastic examples, and I think for all our speakers, just talking to the different approaches and metrics, and just so many different interesting databases that you're pulling from. I did want to leave time for a few questions, so I wanted to provide that opportunity for the audience to jump in. I think there's let me get some microphones spinning around. If you can introduce yourself too, that would be great.
Hi, Richard Zimmerman at HSBC. Just a quick question on fixed income. Are the rating agencies doing this kind of work? And I'm thinking especially not just for maybe at a utility level, but at a municipality level, government, state level, local, et cetera, because as they start to get more, I think there could be more downgrades or information put out there.
Yeah, that's a good question. Moody's and S&P have done some kind of commentaries, short commentaries, where they talked about the drought-related risks in California. So they've done some commentaries, but as far as full integration of ESG into the rating process, I think it's still very early stages. S&P in they've just put out a request for comments on their rating criteria, their methodology for the water and sewer utility sector, and I think it's for the first time they did address climate-related planning as a measure of assessing management quality. So that's out right now in their request for comment. So that is definitely promising. But I think, but as far as I am aware, it's still very early stages. I understand that Moody's has 2 employees that are looking at ESG and water risks and assessing those, but I'm not sure how much progress has been made at this point.
I would just add, if you have more questions after Charlene Nurigan, our water team, engages with credit rating agencies on these risks, so can give you some perspective as well. So, great. Any other questions?
Peter Adrian's Queries Risk Analytics, also a professor at the University of Michigan Law School of Business. I think one of the highlights for me that came out of this panel is the importance, I guess, of driving down ESG risk to market pricing, I guess, of that risk. I mean, to have at least that combination. We've done the same thing with public equities, as what Bruce was talking about, using water type of metrics, where we you see that if you take all that liquidity, your pun intended, kind of companies out, that you've actually really dent your performance of your portfolio. So I just wanted to hear from everyone on the panel on, I guess, where you see the field evolving to, I guess, in terms of driving pure ESG risk into financial performance risk of these various different companies, either through capital asset price models or other.
Well, this is when I wish my portfolio manager here was here to speak for me. So I'm going to pass on this question just because I'd rather have my portfolio manager speak to that.
I think the future comes from activities like this, like Ceres, SASB, etc., putting more information out there. I wouldn't say pressure, but I would say more assertion of disclosure. And companies, companies are getting a lot more sophisticated around these issues. And as that information, enters into the Bloomberg terminal, where's Curtis? Then investors like us will price it, and that's what we're looking for, right? That the reason why things aren't efficiently priced, or a true price, efficient would probably not be the right word, right? A true price of the cost of water in this case, it's because we don't have the data sitting in the Bloomberg terminal. Right, and as that data trickles into the Bloomberg terminal, the capital markets will price it, and it will price it quickly. And so, that's why folks who are picking up on this now are positioning themselves ahead of that repricing. And that doesn't go just for water. That goes for carbon, human capital, all these things. As they get repriced, the capital markets will price it pretty quickly. So it's just more data, more research, more activities on the corporation's part, and disclosure is going to lead to that repricing.
Hi, this is Jyoti with Scarsdale Equities. My question was for you, Monica, about the actual study. What was the thinking behind choosing asset management companies to do the survey versus going to the global sell-side research and talking to all of the people who are pricing or at least putting a value on the companies and what's out there? And why the managers? Why not people who are actually creating the price?
Right. I guess it was just limited time and resources initially, but that this is very much one element of a lot of the work that we do at Ceres with investors. So it was just selectively looking at this group with the knowledge that, and the hope that it will start more conversations with the sell side, with ESG research providers, data providers, but that we will very much be engaging those groups as well as we continue this work. So it's.
I almost feel we need the global heads of research of all of them.
Oh yeah, that'll be the next event. So, yeah, please.
So we do a lot of research on the research of sell-side researchers, and it is really a huge database. So we have 6 terabytes of data on sell-side recommendations and et cetera. So in the water sector, right, the analysts, so lots of folks will cover ESG really well, or they're covering it as a special product, like we have people in the room who do this. But what are you after? Are you after that the sell side has good industry knowledge or knows about water trends, or are you actually after whether an analyst can accurately predict the stock price of a company? And if it's a water company, what is that what you're looking to measure? So we look to measure that, and we find that in the water space, the water companies, in the thematic of water, not how water affects a global conglomerate, but a water company, there's not as much coverage, and those analysts may be really good at understanding industry. They really deliver company management meetings, but their ability to predict stock movement is not that great. And that comes from just not having a lot of experience in it. These are sectors that are kind of pushed to the side of some of the research departments you're talking about, right? These are not huge commission generating securities, so they're not going to be necessarily that covered that well. Hopefully that'll change.
Yeah, and in the report we do discuss sort of the research ecosystem and what a lot of the aspirations are around that research ecosystem, and what fund managers and asset owners are looking for. So that will be hopefully helpful to the space as well. So I think we have time for one last question, and then please go ahead, and then we'll wrap.
My name is Tom Melton. I'm with Echo Asset Management Partners. This question's for Robert. I'm wondering if the label green bonds, how that plays into your screening criterion, if at all.
Yeah, that's I think overall, I guess we would say internally sometimes we have a love-hate relationship with green bonds. I think green bonds have a lot of really excellent qualities where they can highlight key environmental projects that need to be financed that maybe were not getting financed before. Sometimes we get worried internally about what we're offering is an integrated ESG strategy. We're worried that sometimes managers or asset owners will say, "Oh, we've integrated ESG by just buying a couple green bonds," and leaving it at that. Overall, though, as far as part of our investment process, we're considering credit quality as well as valuation. A green bond just helps to highlight a security that is looking to fund a key environmental related project. So it's a really nice label, and we're very supportive of the growth of the market. But it's just one other element of our evaluation process.
Okay, I really wanted to thank our panel.